Hey everyone, John Blackman here with the Heart of Austin Homes team. And today I'm going to walk through investments in terms of risk versus reward. So one of the questions that I get from investors all the time is, hey, can you just find me a deal? Right? Like it's just this, magic gem on a shelf and I'm just going to go find you one. Well, I do that, but deals are different depending on what your goals are. So I do a lot of development and I like those, but it takes a year to buy a piece of land, prep it, get it permitted, build it, and then sell it. And to me, that's a deal. But it takes, a full year, maybe 9 months if I'm lucky, to do that end to end, and that's still a deal. But it takes time. So if I were to bring that to some investors, they're gonna look at that and go like, there's no way I wanna manage or be involved with a new construction flip for 12 months. Others might be, hey, I want just mailbox money. I wanna put my money to work, and I just want that money to show up as an investment passively without really having to lift a finger. So even though a single family rental might do that almost, it's not gonna do it entirely because you're still gonna have to do a little bit of work to make sure that that money is flowing and nothing is going wrong with the property. So I'm gonna go through just a couple of investments and their risk versus reward and time component in terms of what you might come to expect. And now these things change all the time, but this is just kind of what I'm seeing right now. So the first one is going to be, let's say, single family. Now this is your typical like, hey, I want to own a home and rent it out. Pretty normal, a lot of people do it, it's great. Now, you're gonna have to manage that tenant and you're gonna have to keep it repaired. One of the things I like to do when buying single families is just make sure that you put the cost of the HVAC and heating replacement into the deal right up front. That way you know it'll last 10 or 15 years and you won't have any of those big capital surprises come and show up in the middle of your returns, which can wipe them out entirely. So if you just assume that when you buy, you're gonna have to replace the mechanicals or you just replace them at the very beginning, that's a good way to make sure that your returns are gonna be real stable over the next 15 years of the lifetime of those mechanicals. So a single family is pretty low risk, right? As long as you buy it with 20% down or so, or even 10%, and it's an appreciating market and you get it a tenant in there, chances are you're going to be able to make that cash flow. You have to buy it right and make sure that it does cash flow, of course, or at least is cash stable, and you can bet on the appreciation, but the risk is relatively low. If you had to get rid of it, you could probably sell it for your cash in and then go try something else. So, but the reward is also kind of low. I mean, a good rental, depending on your market, is probably going to be between 8 and 15% year on year. And if you're paying anyone else to manage that, that's going to get eaten up pretty quick. Now, I know these are kind of broad strokes. This doesn't mean that like every rental's like that. There's plenty of people that will disagree with me. But in general, a single family home is going to be low risk, low reward. So if we do something like a new build, or let's do a fix and flip. Here the risk is medium. And the reward is also medium, right? It's getting a little bit higher. The reason being that is you're buying the house, you're gonna fix it, and then you've gotta sell it. But you're holding on to a lot of capital for a very short time. So you can make, those 5-figure spreads on a fix and flip if you buy it right, but that's also very short term. You're also gonna do a lot of work. That's not passive money at all. You're gonna be dealing with subs and everything that it takes to fix and flip and then market and sell that property. So there's a lot of time component in that, guys. So this one is really time heavy, right? Whereas a single family is mostly time heavy when you get the tenant in there. And now if we do one of my favorites, which I like, which is new construction. This is similar to a fix and flip, but there's more capital involved. So the risk is much higher because now when you buy that asset, it's brand new, you buy a bunch of sticks and putting them together, you don't have something that is a known quantity, and so you're anticipating the market, so that's why they call them spec builds, because you're speculating. But the rewards are also much higher. And these also have a very high time component, because you're gonna have to manage builders, manage banks, do all the permitting, do all the marketing to sell, so your spectrum starting to go up. Now, two other investments that I'll go over real quickly that change this up a bit are, let's say, multifamily. Now, to me, this is a very low risk investment because the day you buy multifamily, it should be cash flowing right away. And the concept is kind of similar with a single family house. You want to buy it, fix up the units or increase the tenants, increase the rents, and then value that property higher and then sell it at a higher valuation. But what I love about multifamily is the day you buy it, it's paying you, right? It's getting cash flow right away. And it has multiple tenants, so you don't have to rely on one tenant being in that building. You've got dozens of tenants, so your vacancy rate is going to be relatively small, and if someone does move out, it doesn't kill your cash flow. Whereas in single family, if someone moves out, your cash flow is dead until you get another person in there, which might take you a month or two. So for that reason, I really like multifamily. The reward of multifamily can also be really high. So you can see, you know, looking at our matrix, low risk, high reward. Yeah, I love multifamily. Because of the way they're valued, you can buy multifamily and use Freddie Fannie money as long as the valuation is proper. And then when you buy and then increase the value of that property and sell, you can get a very leveraged return on multifamily. So it's a very popular asset class. It's kind of difficult to find good deals. They are out there. I haven't technically done a multifamily yet, but I would love to. I know some really successful syndicators in that space. But anyway, it's a good asset class, and many people like it for that reason. The last one I'll talk about is our notes. And I'm going to call this one, there are a lot of different types of notes out there. I'm going to say low to medium. And the rewards are probably medium. Or maybe I would say low to medium, but not a lot of time component. In fact, there's almost like zero time. And actually, I forgot multifamily. It's going to be a decently high time component unless you're a passive investor. If you're doing this yourself, it's going to be a lot of time. But the nice thing about notes is that once you buy a note, basically you're just acting like the bank. Someone's paying you the money, and if they don't pay you, you go foreclose on the property and then try and liquidate it or find a new borrower or what have you. The risk is relatively low, assuming that you get that note for a low portion of the value of the property that secures it. So if the house or building is worth $1 million and your note is $500,000, that's a 50% loan to value. And then if you needed to go sell that property, you can sell it at a discount to recover the cost of your note pretty easily. You can still sell it for $700,000 or $800,000 and easily cover the cost of your note. So it depends, a lot of variables when you create notes, but I like them for the fact that once you create them, you're just the bank. You don't have to fix anything. The owner fixes the building and maintains the building, and you just collect the debts. The reward is also low to medium on that side. A note, private note is generally anywhere from 8 to 12% plus points. I'm part of a hard money fund with my friend Andrew Miller of the Detroit Lending Group, and we buy all sorts of property and create notes on those. Actually, we don't buy the property, we create notes on this property. And so that's exactly what that fund does. And I like that because the time component is relatively low. You have to originate the note, but otherwise you're just taking in the mailbox money. And the rewards they're not quite as high as, like a new construction or a multifamily flip, but they're nice and consistent. And also as rates move, then the return on those notes are also going to move with those rates if you structure it properly. So hopefully that gives you a little bit of insight into risk and reward types for different types of investments. A lot of it, to me, really doesn't come down to the reward as much as the time component, because I have to be very careful with my time. We've all only got so much of it. People can get really seduced by these high returns and be like, oh yeah, I want to do that. But you have to keep in mind, it's going to take your time away from doing something else, which you might be much more efficient at, like say your job. So hopefully that'll give you a little bit of understanding so that when you say, hey John, bring me a deal, I'm going to ask you, okay, well, what kind of deal? What's your goal? Do you want something that's, low time, like you can just be in Guatemala and you get the paychecks in the bank every month? Or do you want to go for gold and take on some leveraged debt risk and some time to do a new construction flip, or something like that? So there's the whole spectrum in between. So hopefully that is helpful for you, and I'll see you on the next one. Thanks.